Hello everybody, Tortoise Investing going to be coming at you today with 3 of the best stocks to buy now. These are 3 that I feel are either at dips or I feel are at pretty good values for long term. We're going to be looking at these through Qualtrim Insights. In case you don't know what this is, it is a software through Joseph Carlson. It kind of breaks down everything: revenue, EBITDA, cash to debt, EPS, shares, dividends, everything with each company. So we're going to take a look at all of these using this software. If you are new, please hit that subscribe button for me and drop a like down below. Those things help the channel and the videos out a ton, and I greatly appreciate it. Y'all are awesome. Do you own any of these? Let me know down below as well. None of this financial advice. Always do your own research for investing. Now, quick peek at the portfolio, sitting at $951 right now. And one's still being funny and won't let me log in on the computer, but let me log in on my phone app. So I'm going to have to hit up customer support about that eventually. But this is how things are looking right now. Salesforce, United Health Group, Starbucks, MasterCard, and Celsius are the current holdings in the portfolio. We're a little bit down in Celsius and a little bit down in MasterCard. Not much at all. So I'm hoping come Friday I'm able to buy more MasterCard. I would love that. I would just dump all that I have into it, especially if MasterCard stays at these current values. And, of course, my Roth IRA. Just SCHG, and I throw what little bit of extra money I get here and there into it. All right, so let's go ahead. We're going to be taking a look at MasterCard, Google, and Starbucks. I know Starbucks was on the best restaurants to buy now, but I still think that it's such a great value, especially below 80, that like I can't not include this. I feel like I've included this a bunch in my past videos, but I can't help but drill it in just how good of a value I feel that this company is currently at. Again, personal preference, always do your own in research before investing. But without further ado, MasterCard, just free cash flow yield 2.59%, dividend yield 0.6%, payout ratio below 20%. This is a big dividend grower. So year to date up 4%, over the last year 9.43%, over the last 5 years 57.54%, and over the last 10 years 461.94%. That's what I'm talking about. Take a look at the revenue, growing at a rate of 11.64% over the last 10 years. That is just beautiful. The total number of MasterCards are also increasing year over year, which is fantastic. We are sitting at 3.01 billion MasterCards out there. That's just awesome. And as you can see, just a nice little trend up and to the right over time. More MasterCards that are out there, more spending, more fees that they're going to be able to collect, and the more money they will be able to make. Cash flow. Free cash flow growing at 11.71% over the last 10 years. Very, very nice. And if you look at free cash flow per share, 14.53. What's that tell you? It tells you that they are buying back those shares. And I love that. Absolutely love that. EPS growing at a rate of 16.54%. That's just awesome. Everything with this company is just like check. Love everything that I'm seeing here. We'll take a look at the dividend. Dividend's been growing at a rate of 19.62% over the last 10 years. The last hikes have been around 15%. I'm not going to complain about that. You're giving me double-digit growth. Like 15% is just awesome. Usually whenever you invest into a company, you want it to be more than like 2 or 3% typically, because you want inflation beating growth out of your dividend. Of course, there are some things where you make exceptions, some cover call ETFs, stuff like that. But usually with a single company, you want mid-single digits plus at least. And this definitely checks that box as well. Return on capital employed is another thing. It's just silly if this company, 55.56%. That is just bonkers. You cut that in half twice, and you're still beating a lot of companies out there. A lot of companies average around 9 to 10% with their return on capital employed. Not MasterCard. Absolutely nuts. So we're going to take a look here at the quarter-over-quarter updated debt. We're setting at $13.54 billion for Q1. My general rule of thumb, I don't like companies that have more than 3 times their EBITDA in debt. And this isn't even close. Their financial sheet is phenomenal. $15 billion in EBITDA. Like I said, compared to the $13 billion in debt, they could pay this off easily. And not to mention, they have over $7.66 billion in cash. Awesome. Next thing, shares outstanding, but increasing these at a rate of 2.37% over the last 10 years, which is lovely. Still buying them back pretty aggressively. And yeah, what they do with their extra free cash flow is they give you dividend hikes and they buy back shares. Love it. Okay, we'll take a look here at the analyst estimates. EPS average $14.29, growing to $16.58 from this year to next year. So that is some double-digit growth right there. And revenue, $27.83 billion, growing to $31.29 billion. And again, that is more than 10% growth. Love it. This company just checks every single box. I cannot brag about this company enough. Next up, the old Google. Sitting at a adjusted free cash flow yield of 2.03%. Dividend yield, they just started paying us 0.43%. You know, it's right in. It's starting off. With that dividend. Over last year, up 33.94% over the last is year to date. Over the last year, 48.47 over the last 5 years, 221.69 over the last 10. 524.18%. Bonkers. I would love to have had the knowledge that I do now, and I would have been gobbling this thing up in this area. But you know what? I still think that it's worth what it is right now. I still think that this is a great long-term hold. You're going to get something just started paying a dividend, and you know that dividend's going to be growing more than likely at a at a greater than 10% rate. So it's something you're going to be able to snowball with perfectly. But let's take a look at everything. Revenue growing at a rate of 17.78% over the last 10 years. And also, side note, I called Google paying a dividend a month and a half before they started paying it. If people said I was crazy, all I'm saying, revenue by segment increasing year over year. Cloud operation margins. Looks like that's getting better too. Very nice. Free cash flow, 19.92% over the last 10 years. And this is why I was just like, look at how much cash they're just sitting on. Just sitting there. I was like, they're going to pay a dividend soon. I got a feeling. Pat myself on the back for that one. EPS, 19.83% over the last 10 years. Just taking off. Debt, we'll take a look at that in the updated, but the dividend, 20 cents per share, not too much, but it's starting off. Return on capital employed, 26.29% as of last year. Again, very nice, very, very nice. Cut it in half, you're still looking good. EPS, $7.55, growing to $8.61, so double-digit growth still out of that. And the revenue, $346.78 billion, growing to $385.47 billion. So again, more than 10% growth out of that revenue. Now let's take a look at the quarterly. They have $108 billion in cash, $11.56 billion in debt. They could just pay this off. It's just like, meh, pay it off. Get rid of it. We don't need it. Just look at that. The cash on hand's over $100 billion. Silly. Shares outstanding. This is something that they have been working on here lately. Over the last 2 years, a rate of 3.14%. It is rapidly declining, which again, love to see that. That's what I want happening. Do that more. Man, I really hope this pulls back a little bit more. I know a lot of people would be satisfied with it right now, but I'm greedy. But if I see that this starts trending back up and it doesn't give me another opportunity, another little pullback, I might just start a position in it and DCA through. I don't know yet. I've made up my mind. And the next one, this was featured in our last episode of Best Restaurant Stocks to Buy Now. We got Starbucks. 4.29% cash flow yield, 3.05% dividend yield, payout ratio just below 62%. Year to date down 20% over the last year, down 25.86%. Over the last 5 years, down 17%. And over the last 10 years, up 89.68%. So what's going on? A lot of restaurant stocks are going through a massive dip right now. Darden, you got McDonald's was, struggling for a hot minute. I think they're still in the 250s. But yeah, this one was catching its legs at one point. Yeah, we were catching our footing over 107. Fell right back down. That's whenever I started my positions, this dip. And, been DCAing into it. I love it. I love Starbucks long term. I don't think it's going anywhere anytime soon. Revenue's grown at a rate of 8.14% over the last 10 years. One big thing that they're just like iffy on is their 90-day reward members went down pretty significantly, over 1 million. I think this is just a minor hiccup. I think this is going to get right back at it, and 2024 will ultimately beat 2023 in the long term. Yeah, I look at this as just a temporary little bump in the road. They have a lot of political things, the unions and all the everything's going on with this stock, and just a little bit of bad news will send this thing just plummeting, and then it's a buying opportunity. Total stores, this is growing year over year as well. We're setting at 39,850 current stores worldwide. I know that they are still looking into China and a lot of international as a great opportunity to expand into and just continue growing their foothold on the caffeine space in the world. Free cash flow, this is trending in the right direction. We did have this 2020, but a lot of things had a 2020, but this is slowly going up over time. I would like to see it more consistently growing over time, but you know what? Not going to complain too much. EPS growing at a rate over 10% over the last 10 years. Very nice, up and to the right. And the dividend growing at a rate over the last 10 years, right at 16%. But here lately, we're looking at 7 to 8% dividend increases. So slower, but still significant. Significant with their dividend growth. Again, like I stated earlier, you usually want to invest in things that have greater than, you don't want 2% dividend growth out of your company because inflation's just going to be eating that up. But this looks good to me. I like it. Return on capital employed as of last year's 29.21%. Again, beautiful. Market averages are usually 9 to 10%. So take a look at the quarterly. Debt's at $15.55 billion, and cash is $3.13 billion. And I think their EBITDA was 7.33. So it's about 2 times leverage. A little bit over, not a problem. Checks my boxes. And lastly, let's take a look at the shares outstanding, decreasing that rate of 2.93% over the last 10 years. I hope that they are taking advantage of this dip right now. I really want them to be buying back shares at the moment. Take advantage of these pullback opportunities. Decrease that share count. Increase that EPS. Do it. Do what you got to do, Starbucks. It's going to help you in the long term. You're returning equity to your shareholders in the best way possible, which I feel is share buybacks. EPS 2024, we're setting at $3.59, growing to $4.21. Nice double-digit growth right there. Revenue $36.81 billion, grown to $39.94 billion, and I think that is either 10% or right at 10% with the revenue growth, which is also very nice. But yeah, 3 of the best dividend stocks to buy now. Hope you enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, take care. See yous.